One day, you wake up to the worst headline imaginable. A war has just begun. Missiles are flying. Cities are evacuating. Oil prices are surging. Television anchors speak in hushed voices. You expect the stock market to collapse. Instead, the market closes higher. Not by a little, sometimes by a lot. It feels almost offensive. How can investors celebrate while the world falls apart? Is Wall Street profiting from human suffering? Or is something much stranger happening beneath the surface? Because the truth is, the stock market isn't a scoreboard for humanity. It's a pricing machine. And once you understand what it's actually measuring, those confusing headlines start to make sense. The stock market doesn't ask one question. Is the world okay? It asks a completely different one. Will companies make more money in the future than investors expected yesterday? That tiny difference changes everything. Imagine you own a construction company. A devastating hurricane destroys thousands of homes. It's a tragedy. Families lose everything. But suddenly, demand for builders explodes. Your company receives more contracts than ever before. Your business grows even though the disaster is real. The event is terrible. The business outcome is positive. The stock market thinks this way every day. It separates emotion from earnings. That's why wars can create one of the biggest disconnects in finance. When conflict begins, not every company loses. Some are hit immediately. Airlines see fewer travelers. Hotels lose tourists. Luxury brands face weaker demand. Global trade slows. But other industries experience the exact opposite. Defense companies receive massive government contracts. Energy producers can benefit from higher oil prices. Cybersecurity firms suddenly become essential. Manufacturers of drones, satellites, and military technology see demand surge almost overnight. The market doesn't rise because war is good. It rises because some businesses suddenly become much more profitable, and the largest companies have an outsized influence on major indexes. But that's only part of the story. The bigger reason is uncertainty. Financial markets hate uncertainty more than almost anything else. Imagine waiting for the results of a critical medical test. The wait-in is unbearable. Even bad news can feel less stressful than not knowing. Markets work the same way. Before a war begins, investors imagine every possible disaster. Global recession, energy shortages, financial panic. Those fears push prices down long before the first shot is fired. Then the conflict starts. Ironically, uncertainty begins to shrink. Investors stop asking, what if? They start asking, what happens next? Sometimes, the reality turns out to be less catastrophic than the worst-case scenario everyone had imagined. And when expectations improve, prices rise. Not because the situation is good, because it isn't as bad as investors feared. Wall Street has a saying, buy the rumor, sell the news. It sounds backward, but markets price expectations, not headlines. There's another force quietly pushing stock prices higher during many conflicts. Governments. Wars are incredibly expensive. Countries don't simply cut a check. They spend enormous amounts of borrowed money. Military budgets expand. Factories receive new orders. Infrastructure is upgraded. Technology spending accelerates. Billions or even trillions of dollars begin flowing through the economy. That money doesn't disappear. It becomes wages, corporate revenue, supplier contracts, research funding, and ultimately, profits. For some companies, war creates a wave of demand that can last for years. History offers several examples. During World War II, American factories transformed almost overnight. Automakers built tanks. Industrial firms built aircraft. Manufacturing exploded. The economy expanded rapidly. That didn't make the war beneficial. The human cost was horrific, but it demonstrated something uncomfortable. Economic activity and human well-being are not always moving in the same direction. The stock market measures one, not the other. There's another misconception worth clearing up. People often believe that if a war starts, investors simply panic and sell everything. In reality, professional investors ask a different question. If I don't own this asset, what should I own instead? If one region becomes dangerous, money often flows somewhere perceived as safer. For decades, the United States has frequently benefited from this dynamic. Global investors buy US Treasury bonds. Many also buy American stocks. So, ironically, a crisis in one part of the world can increase demand for financial assets somewhere else. Markets don't search for perfection. They search for the least risky option available. But here's the part that rarely makes the headlines. War doesn't create wealth. It shifts it. Resources move from one sector to another. Governments accumulate debt. Inflation often rises. Interest rates may stay higher for longer. Eventually, someone has to pay the bill. History shows that the longer conflicts last, the more difficult those economic costs become to ignore. Higher borrowing, higher taxes, higher interest payments, slower long-term growth. The early optimism can fade. Markets begin focusing less on military contracts and more on debt, inflation, and shrinking government budgets. That's why wars don't automatically create bull markets. Sometimes stocks rise, sometimes they fall, sometimes they do both within the same conflict. Because war itself isn't what markets are pricing. They're pricing the future, and the future changes every single day. So the next time you see a headline saying, "Conflict escalates," followed by another saying, "Stocks reach a record high," don't assume Wall Street is celebrating war. It isn't. The market is simply making a prediction, right or wrong, cold, mathematical, and often misunderstood. Because the stock market has never been a measure of how the world feels. It's a measure of what investors believe the world's biggest companies will earn tomorrow. And those are two very different things. The real question isn't why stocks sometimes rise during war. The real question is, what future are investors seeing that everyone else hasn't seen yet?